You are sitting across from a leasing agent. The apartment is good, clean, right neighborhood. The monthly rent is $2,100. You do the mental calculation. You can handle $2,100. You sign. 3 weeks later, you are scrolling property listings on your phone. There is a townhouse 2 streets away, 2 bedrooms, small yard. The mortgage payment at current rates works out to $2,100 a month. You look at both numbers. They are identical. You close the listing. Renting is just easier right now. Sound familiar? Because here is what your brain just did in that moment, and why that single comparison is one of the most expensive mental shortcuts in personal finance. $2,100 a month to rent, $2,100 a month to own. Same number, completely different financial reality. 30 years from now, the renter has paid $756,000 and owns nothing. 30 years from now, the mortgage holder has paid $756,000 and owns an asset worth $932,000. Same monthly number. $932,000, different outcome. By the end of this video, you will understand exactly why your brain treats these two decisions as equivalent, and the one calculation that permanently changes how you read every housing number for the rest of your life. This mechanism has a name. It is called payment decoupling, and it was first documented systematically by behavioral economists studying how consumers process financial products structured as monthly payments rather than total costs. The insight is precise. When a financial decision is presented as a monthly payment, the brain evaluates affordability. Can I handle this number each month? Rather than value, what am I actually getting for the total amount spent? The monthly payment decouples the decision from its total cost. And once that decoupling happens, the brain compares monthly numbers to monthly numbers, rather than outcomes to outcomes. $2,100 rent feels equivalent to $2,100 mortgage. Not because they are equivalent, but because the number your brain is evaluating is the same. This is anchoring bias, first formally documented by Amos Tversky and Daniel Kahneman in 1974, in a paper that helped Kahneman win the Nobel Prize in Economics in 2002. The brain takes the first prominent number it encounters, the monthly payment, and uses it as the anchor for all subsequent evaluation. Everything else is measured relative to that anchor. The monthly payment is the anchor. The total cost is never calculated. The outcome, zero equity versus $932,000 of asset, never enters the comparison at all. And the rental industry knows this. Rental property management companies are trained to present monthly costs, not annual costs, not 5-year costs, not the total you will pay across your lease period, the monthly number, because the monthly number triggers the affordability calculation rather than the value calculation. An apartment listed at $2,100 a month feels affordable. The same apartment listed as a $252,000 10-year commitment feels like a contract you need to think harder about. Same apartment, same money, different brain response. The industry uses payment decoupling deliberately because it works. I want to tell you about David. David is 34, project coordinator, $71,000 a year. He has been renting the same apartment for 8 years. He is not renting because he cannot afford to buy. He is renting because 8 years ago he looked at the monthly rent number and the monthly mortgage number for a comparable property, and they looked similar enough that renting felt like the easier and more flexible choice. The rent was $2,000 a month. The mortgage would have been $2,100. He chose the lower monthly number. 8 years later, David has paid $192,000 in rent. He has zero equity. If he had bought the comparable property 8 years ago, at the rates and prices available then, he would today have a home worth approximately $415,000 and a remaining mortgage balance of approximately $282,000. His equity position would be $133,000. Instead, his equity position is zero. The gap, $133,000, is not the result of one expensive decision. It is the compound result of a mental shortcut that compared monthly numbers instead of outcomes. The same mental shortcut he made the day he signed the lease. The same one he made when he renewed it. The same one he made every time he opened a property listing and felt the mortgage number and the rent number sitting beside each other in his head. Like they were measuring the same thing. They were never measuring the same thing. This is what I call the monthly number thinker. Not because David is careless or financially naive, Because the entire housing market presents its options in monthly payment format, and the monthly number thinker evaluates housing decisions at the level the market presents them. The monthly comparison sets the frame. The total cost never arrives. The destination of the money never enters the calculation. Most people evaluating housing right now are monthly number thinkers, not because they lack financial intelligence, because nothing in the process of renting or buying ever asks them to run the numbers at the level that actually matters. Here is how the numbers actually work inside a mortgage that your brain never calculates at the point of comparison. When you make a mortgage payment, it splits into two components. One component goes to interest, the cost of borrowing. One component goes to principal, the reduction of your debt and the building of your equity. In the early years of a mortgage, the split favors interest. On a $320,000 mortgage at 6.5%, the first monthly payment of $2,100 sends $1,733 to interest and $367 to equity. The renter sending $2,100 to a landlord sends $0 to equity. By year 5, the equity component has grown. Each payment sends $507 to equity. By year 10, $701 per payment. The equity velocity accelerates as the balance reduces. Every month, the gap between the renter's net position and the owner's net position grows, not dramatically in any single month, but consistently, silently, compounding. This is what payment decoupling hides, not just the total cost, but the direction of the money. Rent goes to a landlord's equity. A mortgage payment goes partly to a lender and partly to your own. When your brain compares monthly numbers, it compares the size of the payment. It does not compare the destination of the money. So what separates the monthly number thinker from the outcome thinker? Not more discipline. Discipline does not help when the decision is made before the discipline can activate. At the moment, the brain anchors on the monthly number and the evaluation is over before the full picture can arrive. Not more financial literacy in the abstract. Knowing that mortgages build equity does not override anchoring bias in the moment. Most people who chose to rent over the last decade knew intellectually that mortgages build equity. They still made the comparison on the monthly number. The outcome thinker is not someone who earns more than David. They are not smarter about money than David. They are someone who learned to run 3 numbers before the monthly comparison sets the frame. So the anchor never gets the chance to make rent and a mortgage feel like the same decision. Here is what the outcome thinker sees before they evaluate any housing option. $2,100 a month, 30 years of rent, $756,000 paid, 0 owned, 30 years of mortgage, $756,000 paid, $932,000 owned, same monthly number, $932,000 different outcome. Once you have seen those 4 lines side by side, the monthly comparison loses its power permanently. The anchor cannot set on a number you have already translated into its 30-year consequence. 3 tools produce that translation before the anchor sets. The first is the total cost projection. Before you evaluate any housing decision, renting or buying, you calculate the 5 and 10-year total cost of each option first. Not the monthly, the total. $2,100 a month sounds like a manageable number. $126,000 over 5 years is a contract you weigh differently. $252,000 over 10 years is a number that forces a different question. What do I own at the end of this? The calculation takes 45 seconds with a phone calculator. Multiply the monthly by 12. Multiply by the number of years you realistically expect to stay. Write that number down before you look at monthly payments side by side. Your brain cannot anchor on a monthly number after it has already processed a total. The total resets the evaluation frame. David runs this calculation now for every housing decision, not because it always points toward buying. Sometimes renting is genuinely the better financial decision in specific markets and life circumstances, but because running the total cost first forces the comparison to happen at the right level, outcomes versus outcomes, not monthly numbers versus monthly numbers. The second is the equity velocity check. Before signing any lease, ask one question about the equivalent purchase in that neighborhood, not, can I afford the mortgage? What percentage of each monthly payment builds equity in year 1 versus year 5 versus year 10? This check changes the emotional weight of the comparison. A mortgage where $367 of every $2,100 builds your equity in month 1 feels different from a rent payment where 0 of every $2,100 builds anything. The monthly number is the same. The equity velocity makes the destination of the money visible in a way the monthly comparison never does. The third is the price-to-rent ratio. For any property in any market, divide the purchase price by the annual rent of an equivalent property. A price-to-rent ratio below 15 strongly favors buying. Between 15 and 20, the decision depends on your circumstances and timeline. Above 20, renting may be financially superior depending on what you do with the difference. A $330,000 home in a market where equivalent rent is $2,100 a month has a price-to-rent ratio of 13. Buying is strongly favored. The monthly comparison obscured that. The ratio makes it visible. David ran all 3 calculations last month. He is under contract on a townhouse, not because the monthly mortgage is dramatically lower than his rent. It is not. It is slightly higher. But for the first time, he evaluated the decision at the level of outcomes rather than monthly numbers. The total cost projection, the equity velocity, the price-to-rent ratio. The monthly comparison said the 2 options were approximately equivalent. The outcome comparison said they were not equivalent at all. $133,000 different after 8 years. $932,000 different after 30. Same monthly number. I want to come back to that moment. You are scrolling listings on your phone. The townhouse 2 streets away. The mortgage payment at current rates, $2,100 a month. This time, before you close the listing, you run one number, $2,100 multiplied by 12, multiplied by 10. $252,000 over 10 years for an asset that will likely be worth significantly more than you paid for it versus $252,000 over 10 years for 0. You do not close the listing. You call your bank. Who are you when you stop comparing monthly numbers and start comparing where the money goes? Because that person, the one who ran the total, checked the velocity, looked at the ratio before the anchor set, that person compounds too.